Meantime, our next guest has a new note out this morning. It says there may be a liquidity problem developing in the S&P 500 and that investing has turned into an extreme sport with a hollowing out of the medium time horizon. So strap on your seatbelts, folks. Savita Subramanian. I always say it's Subramanian. Now I'm supposed to say it.
Subramanian.
Don't listen to any of our conversations.
It's hard for me, as you know. No, I want to get it right.
We just talked about it.
Head of U.S. Equity and Quantitative Strategy at Bank of America, Merrill Lynch, is here. We haven't seen you for so many years and saying it wrong the whole time. Okay, well, let's get to this. Let's get to this new note, though.
Yes,
because
so I think
this is scary.
Important.
And
well, I mean, it's scary. I don't think it's something that's going to blow up in our faces, right now. But I think there are certain things that are happening in the equity market that are very different today than what we've seen in the past. So first of all, if you look at pension funds, their allocation to illiquid instruments has increased from, de minimis to almost a quarter of their assets. So their exposure to private equity and real estate today is much higher than it has been historically. So I think what we're worried about is if pension funds that are exposed to illiquid assets that have benefited, so think about private equity and real estate. They've benefited from this super low interest rate environment. We've had a great IPO market until very recently. If anything challenges the private equity story and the valuations are marked down, pension funds might be forced to sell their most liquid areas of the portfolio, which are basically S&P 500 index funds.
But how convinced are you that private equity has not marked stuff properly, and therefore the LPs, the pension funds, are going to have this potential problem?
So I think that, it's a case-by-case basis, but I do think that we've been in an environment that has been super conducive to private equity, right? I mean, what's better than zero interest rates, super accommodative monetary policy, the tightest credit spreads around, massive appetite for equity, for new issuance. So, if any of those dynamics change, I think that valuations are likely to be lower than they are today. And what's a little bit unnerving...
And how fake do you think that valuations are already?
So if you look at private equity valuations, they're at, on one measure, I think we looked at EV to sales, they're at all-time highs. They're higher than they were in 2000 during the tech bubble. They're actually, in some cases, higher than public equity market valuations, where, private equity normally sells at a liquidity discount to public equity, but today, there's no liquidity discount baked into private equity. So that's just something to keep in mind as we move forward. Now, I said 25% of pension funds are in illiquid assets. That's not the whole kit and caboodle, but it's still enough to worry that in times of stress or in times of a liquidity crunch, there might be a rush to exit some of the more public
You've kind of had one foot out of the door for a while, I think.
Of the market?
Yeah. Right? So I'm just wondering, what do you think? A year ago, where do you think? What did you think the S&P would end the year at? What do you think is fair value for? Do you think we're way out ahead of our skis right now? What do you think?
I mean,
what is the fair value for the S&P right now?
Yeah, our outlook for next year, we've got a 3,300 target on the S&P 500.
So above where we are.
And we're looking for upside, and I think the idea is that we've seen enough pent up CapEx, which could be unleashed next year. We've seen enough, this market has been, the most hated bull market of all time. We all say that. And it's true. Asset allocators haven't necessarily pushed all of their exposure into equities. They're still overweight bonds and cash. But I do think that, large U.S. mega-cap tech companies are super crowded. I mean, again, I've mentioned this on your program before, but the overlap between hedge funds...
An important group, too.
And that's in the leadership.
You can't see big gains made without that group, can you?
Well, I think the market could continue to climb higher, but maybe not the same kind of, outsized returns that we've enjoyed over the last few years. So that's just something to keep in mind. This is one of the reasons that we like small caps over large caps for next year.
Do you have any views as we get into the last 2 weeks here?
That's 2 weeks.
No. Just of the technical factors. You're always thinking about different technical factors.
Yeah, so flows.
Obviously, we have the trade issue, which is probably it's not a technical factor. It's a big one.
It's a big macro
flag out
event,
there. But then also, people want to be in certain names at the end of the year.
Yes.
For certain reasons.
So the window
certain people
dressing.
are doing some tax harvest. There's lots of cross currents right now.
Yeah, I mean, I think that there's no reason to sort of sell everything today, but I do think that come January 2nd, there could be a shakeout. So here's where I think that investors will make money is by shifting out of crowded growth big cap stocks into some of the more neglected deep value areas of the market, like financials, like, select industrials companies that haven't really seen any signs of life. And now all of a sudden we could have trade resolution, we could have pent up capex spend. There's a lot of levers that could.
You're betting on trade resolution.
I mean, I think that we get at least a delay or maybe a skinny deal.